Hello and welcome to Crux Investor. We caught up earlier today with David Cole, CEO at EMX Royalties. He talks us through what they've been up to since we spoke in November. A few deals on the table. We're more interested in the cash flow potential from Balya and Timok. So we talked to him about the timing of that, the quantums involved there, and what's happening next. If you want our thoughts and opinions on the conversation, David and the company, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. We've got commentary from experts from around the world on a variety of companies and commodities. Truly insightful stuff. We've got training courses to help you with your own diligence process. We've also done summaries of all the interviews that we've done just to save you some time because we know you're busy. And if you want to join a thriving community of investors sharing their thoughts, ideas with each other in a nice, friendly and safe environment, free from judgment, trolling and abuse, go and join them at cruxinvestor.com/club. I think you'll really enjoy it. And we'd love your feedback too. So give us a like, be appreciated. Leave your thoughts below, get back to everyone. And if you want to see precisely what we talked about today, do take a look in the description below. David, how are you, sir?
Super well, Matthew.
I haven't spoken to you since December.
How are you?
I'm always good. I'm full of life and full of beans. It's all good, but it's too late to be saying Happy New Year to you. So how have you been instead?
You know, we've had a lot of deal flow. Life is good here in Colorado. I'm vaccinated, so I'm pretty happy about that. Yeah, we're rocking and rolling, taking advantage of strong commodity prices, diversifying our portfolio further into base and battery metals, selling lots of projects.
Interesting.
Things are going well.
Bit of diversification. I like it. Hey, well, look, why don't we just remind people of what your business is? Give them that 1 minute overview, helicopter view of, you know, the type of business that you are, and I'll pick it up from there, and we'll talk about some of the things you've been doing recently.
So we're a royalty company, and we love royalties because of the embedded optionality that are in royalties, and thus that's why royalties trade at a premium. But we're a royalty that grows our royalty portfolio in a different way than most royalty companies. Most royalty companies purchase existing royalties or do mine financings to obtain additional royalties, commonly at dear valuations. We, the bulk of the royalties in our portfolio, Matthew, as you know, we have grown organically through the prospect generation business model over a 17-year history where we acquire prospective mineral rights. We add value by building economic geologic models and then sell those on to an industry hungry for discovery opportunity in exchange for cash, shares, annual payments, work commitments, and always a royalty on the back end. So rather than paying dearly to acquire royalties, we're paid to create a royalty. And that's why we're in such strong shape financially, sitting here today with as much money in the bank, and our share portfolio and our long-term investments equate to roughly all the money I've raised in the history of the company, no debt, in addition to 250 mineral property positions. To augment the portfolio that we grow organically through the royalty generation, which I just explained, we also buy royalties occasionally if we can find them a good valuation. That's hard, that's a tough business, but occasionally we are able to execute there. And we also make strategic investments when our team of economic geologists that are out there working hard find compelling opportunities to invest in companies. And our 17-year track record on our invested capital, not including cash in the bank, just on the invested capital in our strategic investment portfolio, is 42% compounded annually over that time frame, after tax.
Okay, you're a royalty company, but it seems a little bit more complicated than that because you go about creating your own royalties. So the kind of G&A, upfront G&A component of that is a little bit more upfront, but further down the line, it saves you paying like big sums of money, to hand a big sum of money over to someone for their royalty. So that's how you do it.
You know, we have a bunch of smart guys, and you like to tease me because you like to say that economic geologists, were they the inexpensive ones? So I know that line, I know that joke's coming, so I just preempted it. But look, these guys are PhDs, great depth of experience on the engineering side, the geology side, and yeah, we have to pay them well. And that intellect is reflected in the growth of the portfolio. So our G&A would be higher. The amount of money we're paying to buy royalties is much lower.
Right. Okay. Well, let's talk about some of the things that you've been doing since we last spoke. It was sort of middle to end of November. Okay, because you've had a bit of news flow. I mean, quite a bit of news flow, and you've been spending money, which I know you don't like to do. So tell me what you've been up to.
Well, core to our business is acquiring prospective mineral rights around the world. We've been doing that at a breakneck pace. As I mentioned, we're broadening our exposure to nickel, copper, cobalt. In addition to continuing to acquire more gold projects, we always love gold. Gold and copper is kind of the base of the company, but we're happy to have exposure to lead, zinc, silver, and polymetallic systems, Fennoscandia, Turkey, etc. I think in 2020, we sold 20 projects, creating 20 new royalties. That was a new record for us. In 2019, we sold 18 projects, and in 2018, we sold 17. So that's a collective 45 projects sold in 3 years, creating 45 new royalties. And that's in addition to the purchase of a couple of royalty portfolios. We purchased a portfolio of royalties, 18, I believe, in Chile, covering some prospective mineral rights there from a company that was in financial distress. We got that at a very good price. We also purchased a portfolio of royalties, 2 different portfolios of royalties in Central Eastern Canada over dominantly gold projects at very good valuation. Those projects do cash flow, not from production, but from pre-production payments in cash and shares. And we expect that portfolio to pay for itself in about 3.5 years. Some of those shares have done very well, in fact, so we might pay for it a little faster than that. And we like that. We like that method. And those were both purchased from companies, private and a public company, that were executing a similar business model of growing their royalty portfolio. And then we were able to purchase that and augment our portfolio. So, if you want to hear the numbers, I believe around 250 mineral property positions, Matthew, worldwide. About 150 of those are in royalty status.
What does that mean?
That means that the partner is earned in, and we have a royalty attached to the project. They're not projects which we're out marketing to find a partner to buy the project from us. Because Of course we have both. We have those projects which we've already sold, quote unquote, and those which we're marketing to sell.
Right. Okay. The reason I ask that is because there's a lot of terminology around. There's a lot of new people coming in, looking at this thing. Oh, royalties, easy. But the nuances are very, very different, because the thing that interests me, cash flow, right? So, if I ask you the question, you said the overall size of the project, but how many assets currently are cash flowing into your business, like free cash flow now today for you?
Yeah, so it's a great question. And so we have a pyramid, right? And the base of the pyramid are the projects we've just acquired. Then above a certain line, that's the projects we've sold. And then we have various forms of cash flow that come in pre-production. And then the very top of the pyramid is production royalties. So producing royalties, we have the Leeville royalty on the Carlin Trend, operated by Nevada Gold Mines. That's a joint venture between Newmont and Barrick. And that's been a production royalty for many years now. It's paid about $15 million since we've owned it, US.
Right.
And then we have the Balya mine, which is coming into production this year. That's going to become a key cash flowing asset for us. That's lead, zinc, silver in Turkey. And I encourage you to check our website for new drill results there. They continue to expand that mineral system, 5,000 ton per day mill. We're very excited. That's going to become our top cash flowing royalty, in my opinion, within 2 years.
How much?
And that will initiate production later this year, in fact. And then the company maker in the portfolio long-term is the Timok project, being operated by Xinjiang in Serbia. And they have announced, and we came out with an update press release 2 weeks ago, perhaps, that explained what Xinjiang has announced. And it's in full agreement with the memorandum of understanding that they signed with the Serbian government to invest roughly $500 million into putting the upper zone of the Timok project into production. So they're putting the upper zone, which is a high-grade pipe, into production. They have 2 declines coming into it to establish underground infrastructure, 2 shafts coming into it. They've announced they've already hit high-grade ore, and they've announced that they'll be in production second quarter. We get paid in arrears on a quarterly basis. So we should have royalty payments initiating from that upper zone in the second half, right middle of this year, within 6 months. And so we're quite excited about that. But the upper zone is small. And so our royalty payments will be, a couple $1 million a year, but based upon the feasibility study. But when they get into the porphyry zone at depth, that's 1.7 billion tons of inferred resource. There, the royalty has a chance to just blow up and become extraordinarily valuable. And of course, we own 0.5% of everything produced that comes out of that. And that long term, that's the company maker in the portfolio.
Right.
And this whole thing speaks to cash flow optionality within that pyramid.
Okay. Can you just firm up on some of those numbers for me? So I get the size of Timok, and I'm aware of it. We studied because we're looking at Adriatic metals operating nearby.
Mhm.
Can you give me the numbers? So Balia, for instance, let's start with Balia. What's the contribution from that to you per year? Because I think you gave me a 15 million number.
Happy to.
What's that?
So, and of course, we're bound by 43101 regulations, what we're allowed to say. So I know a lot more than I'm allowed to say, but keeping it legal, right? There's a 5,000 ton per day mill. The average head grade at that mill is 8% combined lead, zinc, and 80 grams per ton silver. We have been told that they will supply about 50%, ultimately, once in full-scale commercial production from our side of the line. We have a line down the middle of the district, and our side of the line, we have a 4% uncapped, unbuyable royalty. So that's a fat royalty. Very excited about that. And you can do the math on that, and it's multiple millions of dollars per year once in full-scale commercial production at current lead, zinc, silver prices. You can assume, 85, 90% recovery, and then that the smelter pays on about 85% of that metal, and you can do the math yourself. I'm not supposed to do that math because it's not in a 43101 document, but it works out to a nice number per annum. And Balia is moving forward. We came out with a press release that describes that, so you can read that press release. And additional drill information that shows that mineral system is extending at depth and getting stronger is available on our website, so you can review those drill intercepts. We're very excited about the potential for that royalty to pay for many years into the future.
Okay, so those are those two.
A nice royalty.
Yeah,
Yep.
So they have the potential to be a sort of steady state stream for you, and maybe Timok could be much more than that if they really start putting that money in the ground. How many of your other royalties have got 43101 or JORC compliant resources on them?
So certainly the Kaukua royalty has a compliant resource, and they continue to announce additional drill intercepts. In fact, Palladium 1, the counterparty to our royalty in Finland, made a significant press release today with some 4 gram per ton palladium equivalent intercepts as they continue to grow that resource. It has significant endowment. It's a combination of platinum, palladium, gold, copper, and nickel, commodities which we like very much. And this speaks volumes to how we execute our business model. We were working in Finland within these prospective geologic terrains for these polymetallic platinum, nickel, copper systems, acquiring mineral rights. And we met the prospector that owned the royalty on the Kaukua discovery. And we bought that royalty from him for, hold your breath, 250,000 Canadian dollars. That's a 2% royalty, where 1% can be purchased before production for €1 million, leaving us with an uncapped, unbuyable 1% royalty on that mineral system. And Palladium 1 is having great success, and hats off to them. They're running geophysics, finding geophysical anomalies, coming in, drilling them, and hitting metal. And we're just delighted to be a participant in that. So we're a participant in that. And they have a resource. I can't quote the resource number, but you asked about a resource. They have a resource on that, and that resource is growing demonstrably. We also have other royalties around it on other projects that we have sold that have similar geological attributes.
Right. I guess what I'm trying to get at, David, is it's trying to understand what's near term. So in the next 2 years, what's the revenue? What's your revenue expectation? And because again, we talk to people in the marketplace, and the room for misstatement is huge. People talk about royalties, but they forget to tell you that perhaps they're only own 20% of the land, of the resource which is in their royalty, or they talk about being in near production, but there's not even a resource on a project. So I'm just trying to, from you, get a sense of, because I appreciate you've been in it 17 years, right? You've been around the block. You understand the fun and the games here. So, what does the next 2 years look like for you in terms of cash flow, near-term cash flow? What's the gold equivalent number on your resource or reserves that you know about today?
So I can only quote those to the public when they have 43101 compliant resources. And Balia does not, because it's operated by a private Turkish company, so they don't have to do that. So unfortunately, I can't quote that number. But you can see the drill intercepts, and a reasonably intelligent person can calculate a quasi-resource number based upon the footprint of that mineralization. The knowledge it's 5,000 ton per day mill, you can get a sense for what our cash flow will be coming off of that. And specifically answer your question, the near-term production cash flow is from Balya, Chukwurupeki royalty, which is the Timok project, and Leeville. That's from production cash flow within our portfolio. But there's dozens of other royalties that are cash flowing. But to make sure we have the correct terminology here, those are pre-production payments. So they could be annual lease payments, advanced minimum royalty payments, annual advanced royalty payments, however we word them. Sometimes people say, well, we don't pay advanced royalties. We say, okay, you can pay us a lease fee every year. So, okay, so we somehow or another, we always pick up nickels and dimes in front of the steamroller after we sell projects. And so there's 30 or 40 royalties within the portfolio. It might even be more, quite honestly, that are cash flowing, but they're pre-production cash flow.
Got it. And those are fixed term, or are they right until they do get into production, or someone gets into production if they get into production?
Some of those were written by Perry English, the gentleman from whom we bought the portfolio in Canada. So they're not the terms that we would write, but they have maybe a couple of payments left, and then there's no more payments. Most of the ones we write have continued annual payments on into the future. Okay, and I guess what's your key? Mixed bag.
It's a mixed bag, right? Okay, and look, you've been around 17 years. You're growing. So I think last time we spoke, you were 368. You're 395. You're 335 million market cap. It's steadily growing. It's an interesting story, but it's an interesting time for royalties, right? So what I'm trying to do is distinguish between the good and the promotional, right? So you've got some real revenues. You've got $50 million in the bank, and you got no debt. So a lot of things to like. What I'm trying to work out is the speed at which this thing ramps up, right? What's in it for me? Is it a steady state growth because you're careful with your cash, you're careful with your investments, or have you had to change and adapt your model over time from this generate your own royalty model through to, well, do you know what, we better start buying a few things which do get some cash flowing a little bit quicker because our G&A is, a little bit more than most.
So, more than happy to talk about all those things. That was a
thank you. Thank you.
You covered a lot of territory.
You're welcome.
But I do appreciate you highlighting the promotional aspect of the numerous new royalty companies, and I will point out the distinct difference. That is that they are buying royalties to grow their portfolio. The dominant way that we grow our portfolio is by selling projects where we get paid to create royalties. And that's why I have as much money in the bank, plus my tradable securities, plus long-term investments as I've raised in the history of the company and no debt. I don't believe any of our competitors can even come close to saying that. And we have a 17-year track record of just solid, accretive deal flow. When we do buy royalties, it's a good deal. And when we are growing royalties, which we do better than everyone else, in my opinion, I believe we sell more projects for royalties than all the other prospect generators combined. That's just a fantastic way to grow the portfolio. But the Achilles heel of this model, which you've alluded to, and it's worth pointing it out, I'm not shy about it, is that it's the get rich slow plan, right? You sell a project and you get paid upfront shares or cash, and you get some annual payments. But the production from that property isn't likely to occur for a decade, maybe 2 decades. But we've been doing this for 17 years. So we're at the point now where that optionality within that pyramid is starting to really show itself. And Balya is a great example, right? So as an organically grown royalty, we acquired that at auction for $17,000 from the Turkish government. We sold it for $100,000 upfront payment in addition to a 4% royalty. And now it's going to pay millions of dollars per year for decades into the future. That one royalty is worth more than I've spent on growing the entire portfolio. And that speaks to how accretive the allocation of capital is to this business model. And the people that come into this company and buy shares today have the benefit of 17 years of us doing this. And so that's the core part of our business, is to grow these royalties organically through the execution. But we also buy royalties, and we're happy to buy royalties when we find them at accretive pricing. And usually, if we find them at accretive pricing, it's because there's some sort of distressed sale, or we see substantial geologic upside that the market doesn't see. And it comes back to that geologic acumen to be able to look for the inefficiencies.
Okay, so the get rich slow scheme has been the mantra, but I wonder, because I'm looking at share price, right? Like last year, it really took off. I would say previous 4 or 5 years, floating around the sort of same sort of level. It didn't. The value of your previous model hadn't really been seen. I'm looking. Okay, I'm look back to 2016 and see the same sorts of price. Same sort of pricing. A peak 2016 in 2019. So I think in the last year and a half, people are starting to see the payoff, as it were. It feels like, if I'm looking as an investor, because I make my money when my shares go up and I sell them. That's how I make my money. You've got a different model, right? So you've been in this for a long time. So new investors coming in, I think perhaps can take advantage of this. What do you think that investors have been sitting on your stock for the last 3-4 years are thinking about you now? Are they happy?
They should be very happy. So in the point of market capitulation, which occurred in January of 2016, our shares traded as low as 35 cents USD. I remember on December 23rd, 2015, I bought 500,000 shares out of the open market at 0.352 cents and or $0.352, you have 35.2 cents at that point in time. And that marked the capitulation point. And I personally bought a lot of shares during that down tip.
What's the capitulation point? What do you mean by that? What happened?
The point at which the market's throwing in the towel. They're just giving up and prices are falling just because they're falling, not because of any aspect of fundamentals. And the astute followers of the company are saying, this is crazy. Let's buy all the shares we can. And we did that. And then the market turned and now we've gone from 35 cents to $3 US or $4 Canadian. And over that 5-year period. And by the way, if we take out, the market exacerbations within the cycle of the natural resource sector, particularly the junior natural resource sector, are exacerbated. We all realize that. And the key is to use those exacerbated market cycles to your advantage rather than be used by them. And it's easy to say that. But it takes reaching down in your gut and buying those stocks as they're getting beaten up in those really bad markets, which requires guts and money. But long term, that's the way to play this market. This sector within the market is to buy those exacerbated downturns and buy quality companies with quality people that are going to be around a while. So if you look at our compounded annual growth rate, our CAGR, from the time that we first raised money in the company, we first raised money at 15 cents Canadian. We came public at 30 cents Canadian. If you use the 15 cent number and compare it to today, that's a compounded annual growth rate of in the high teens or low 20s, maybe around 20% compounded annual growth rate over 17 years. I'm of the opinion we can continue that type of growth rate.
Okay. I mean, that's a fairly sort of steady state, PE type return. But do you see competition from, if you look at the equities last year, they went nuts. Most precious metal commodities went nuts, that people felt they could do no wrong and they were looking elsewhere. But of recent times, we're seeing many new royalty companies coming out because people are taking notice of royalty companies again. So how do you feel the market's evolving out there in terms of your ability to get noticed, because the precious metal markets come off a little bit, the fact that people are noticing royalty companies a bit, but there's a bit more competition. I mean, there's a lot of moving parts. How are you going to compete?
Focusing on what we know how to do and have shown we can do for 17 years. And that's focused dominantly on the organic growth of royalties, which nobody else does the way we do it. And so we don't have serious competition on that side. In fact, the buoyant markets provide more customers for us to be able to sell projects to. So it actually accelerates our market. On the royalty purchase side, yeah, you're right. Royalties are selling at extreme valuations. We see some absurd. I won't point out any specific deal because I don't want to pick on anyone in the space. But we can easily look at some of the deals that have been announced recently and sort of chuckle to ourselves about the valuation that people are paying for royalties. And that's because they're desperate to grow their company. And most of our royalty competitors are buying royalties to grow their portfolio, and they have to pay any price they can to be able to do that.
And the penalty for them for that is what?
Well, short term it works. They have deal flow. The market is not yet dissecting and understanding what they have purchased for what price, and so in some cases their stock prices have reacted favorably. We all know that's likely to be a short term phenomenon. Long term, you need to buy assets astutely. Long term, it's about astute allocation of capital.
Do you think that you guys, royalty companies broadly, should be more accountable, more open and transparent about how you measure your portfolios, so that people can look at? I know brokers who are in the royalty analysis space. They can't be bothered looking at all of your assets. They literally don't care. They'll just pick a number and they hope it's right in relation to what's going on with the peers. You've got 200 assets to look at. It's hard work. Mm-hmm. How can people judge you? Because not all of you guys talk a straight story, right? You spin it the best possible way. And I talk about, I'm not talking about you, I'm talking about there's some companies out there who are overtly promotional, overstate, and quite a few of the CEOs that I talk to are just incredulous that they can get away with it. But it happens. So what chance have we poor family offices or retail investors got in terms of evaluating who's the good guy and who's not?
Matthew, I think you're pretty good at discerning those things myself. But, you've got to look at people's track records and what the company's accomplished over time and look at what they've purchased for what price. Royalty companies, however, are all hampered, including us, by the terms of the royalty deal. And if we buy a royalty and that royalty says that we have no access to data and no right to go on the project, then there's not a lot we can tell the public about what we own. We can say what the footprint is. We can say this is where the royalty is. This is how much it is. And then we can talk about whatever's been made public by the counterparty. But we can't say anything more than that because we don't have any more of that information. We have some royalties that are encumbered by that problem, but many other royalty companies have that same issue. So it's difficult for a royalty company to tell you what they can't tell you, if that makes any sense. But certainly the entire industry is governed by 43101, and the bulk of the counterparties, if they're public, have to abide by that, or JORC, or U.S. law with respect to their disclosure. And then the royalties should be disclosed in their disclosure, and thus you can figure out what the company owns. Very important is to understand what the commercial terms of the royalty are, i.e. if it can be bought out or if there's a cap, et cetera. And very importantly, the footprint, the actual footprint of the royalty relative to where the resources and reserves and ongoing exploration are.
Yep. Well, it kind of feels like 43101 is not necessarily designed for royalty companies. It feels like, because I think that's
probably a fair statement.
We would like to see more information to stop people being harmed from misdirection. I think in the royalty space. I'll finish off because I know you've got to go and get a shot in the arm.
Yeah.
So you can.
I'm getting my second shot today. Yep.
It's okay. They're showing off. So you've got Balya and you've got Timok, and those are the kind of near-term cash flowing events, right? So you talked about the sustainability of those, but what's next? Because your business, I think, is going to be best defined by how much cash is coming through the door and continues to come through the door down the line, because that's what we're buying into, future cash flows. Mm-hmm. So what can you tell us about that one in the context of, I know what we've just discussed, but you got to have a view or a range.
You like to ask the same question 3 times, hoping you'll get a different answer.
Pretty much.
Look, I'll just come back to this concept of optionality. Royalties trade at a premium, and royalty companies trade at a premium because of the embedded optionality that comes at no cost to the royalty owner. And so when discoveries are made within our pyramid, we weren't paying for those drill rigs. And so we have all the upside of that portfolio. So you never know where the next big win is coming. We love the results coming out of the Kaukua royalty. We're very excited about additional work that Xinjiang is doing on that project and advancing it forward faster than they had initially said. That's going to create more cash flow from us. And long term, when the porphyry comes into production there, that's just a flat out company maker. You can do the math on 0.5% approximately 1% copper equivalent of 1.7 billion tons of mineralization, and put whatever risk factor you want on that and discount it however you want. It's still a big number. And that's a nice asset to have in our portfolio. And we've had a fabulous job of doing accretive strategic investments over our history, which come to us as a synergy of having these smart, business-oriented economic geologists around the world finding investment opportunities for us. And we have a share portfolio that we manage. We continue to buy things, we continue to sell things and harvest. And we've done a fantastic job of that over our 17-year history. It's likely that we'll have other wins that come from that portfolio as well. And I'll highlight our 19.9% interest in the Rawhide mine in Nevada, which is a strategic investment we have on the books today. And we are contributing intellectually to the advancement of that project. And I'm hopeful that's going to be a nice win for us in the future.
Right. And again, I sort of harp on about cash, but do you think you're going to be a net positive or growth cash, a net cash positive growth story moving forward? Because again, I come back to your G&A, because the model which you employ is a little bit more than most, right? So this year is the year where we're going to start seeing a different shaped curve.
So if you include share payments and the value of the share payments and the value of the shares that we have and how they've augmented over the course of last year, we've done very well this year. If you just look at incoming cash, then 2022 is the year we're going to turn positive.
Brilliant. That's where I wanted to get to.
Yeah.
And I want people to understand that.
Right.
Only because you're sitting on this $50 million of cash. And the question which comes in all the time to you, what are you doing with it? What are you doing with it? What are you doing with it? Right? So I know you're doing more deals, but I'm interested in the type of deals.
Yes.
And the change of profile for your company has got to be around, well, are these guys going to be, contributing net positive cash to the bottom line? Or are we just always going to be talking about the future? Because that's a difficult story to kind of get your head around.
Yeah, very fair questions. I get asked these questions frequently. My focus is on the astute allocation of that capital, not the allocation of it. So it's about allocating capital astutely. That's for the long-term value creation of our shareholders.
Right. And as a percentage of your business, it's always been precious metals predominantly. Now battery metals is a big and growing thematic. Is that going to be, what sort of percentage of your portfolio do you think that's going to be going forward? In however you want to measure it.
So the future of the company is more base metals and less precious metals with respect to production cash flow, but it's still a substantial precious metal component. And we love getting exposed to these copper, nickel systems. Some of those have byproduct gold, some have byproduct platinum group elements. We think those are great places to invest. We've been augmenting our portfolio long before it was popular in that area. The whole metal space is seeing a repricing event, and we're a participant in that.
Okay. So brilliant. Okay. No overpaying for things.
It's not in our DNA.
I know it's not, but I'm seeing so much of it. It's driving me crazy. Yeah.
And I get people saying, how come you aren't buying royalties? As if you go to the Walmart royalty store, right? And it's like, well, look, we're only going to buy them if it makes sense.
There's self-service these days at the Walmart royalty company. It's really easy. David, I appreciate the catch up as always. It's good to hear that lots of new news, which I think is exciting. Lots of revenue coming forward. Yeah. I'm excited about that, and so seeing just slight change of the model, as it were, and it's exciting times. Appreciate it. Thank you very much.
Always my pleasure, Matthew.